Okay, great, everyone. Welcome to the Digital Euro Association Thesis Awards. Feel free to stay. There's going to be quite a few interesting presentations by very young and brilliant minds, as it were. I'll just let John and his colleague sort that out. All right, so if I skip ahead here. My name is Conrad. I am a strategic advisor at the Digital Euro Association, and I am privileged to be introducing you to our finalists today. They submitted their theses last year, and we went through a rigorous process of judging those theses, and these three emerged as the top theses finalists. So the DEA, maybe some background about the Thesis Awards. The DEA launched these awards 3 years ago as part of some of one of our three core pillars. The first being education, of course, under which the Thesis Awards is lodged. We also have a pillar on community and collaboration, and then also public affairs. And of course, most important of these three is education, because moving and making meaningful progress in the digital currency space is highly predicated upon educating not only the average person on the ground who are the users of digital currencies, but also commercial banks who are intricately involved in the distribution of central bank digital currencies, for instance, and maybe other forms of digital money, but also regulators at the highest level. We found that many of the regulators and issuers of certain currencies require education on these topics, and our finalists today have put forward very important pieces of work and contributions towards the literature to move the needle in that regard. Maybe just some background in terms of the review process. The three finalists stood out for their originality of work and thought, relevance to policy and market development, analytical depth and clarity, as well as the potential for real-world impact. So we felt that these were quite important in terms of making sure that they aren't just theoretical, but also that they have some practical application. So each of our presenters today will have a 15 to 20 minutes. We do have a bit of a buffer at this stage, so we'll allow a little bit over 15 minutes if required, and after which we'll announce the order of winners in this regard. So without further ado, let's begin. I would like to introduce our first Thesis Awards finalist, and that is Willem Vincent. He is from the University of Twente. I think, I hope I'm pronouncing that correctly.
Yes.
And his thesis is entitled Quantifying the Impact of the Introduction of a CBDC by the ECB on the Dutch Banking Sector. His analysis provides a practical lens into how central bank digital currencies interact with commercial banking models and what risks or safeguards should be in place, including holding limits. And with that, please help me welcome Willem.
Yes. Well, hello everyone. Nice to be able to present my thesis here today. My name is Willem Vincent and I'm from the Netherlands, where Vincent is actually also a first name, so that's often very confusing. Let me dive into it. So I will talk a bit about what I did during my research. I will talk about the model I made. I will talk about scenarios and the results, and I will give a brief conclusion. Please keep in mind that this is a really shortened version, so if you're very interested in it, you can always read my thesis. So I will dive straight into the research question. So in the beginning of my research, I started with the question, what would be the potential financial impact of the introduction of a digital euro on the Dutch banking sector? So, and immediately we found out that that was quite a difficult question. So we identified three main impacts. So we identified impact on financial intermediation, which is that deposits might go to a digital euro account, which means that banks cannot lend out these deposits anymore because they are now on the balance sheet of the central bank, which leads to lower net interest income. Also, we identified that there might be impact on payment services. And yeah, payment factories of banks often have really high fixed costs, while their revenues, their marginal revenues are high per transaction. So if you lose transactions, that can lead to severe impact for a bank. And also, of course, for a bank, there is quite some development costs surrounding the digital euro. Well, during this research, we found out that the last two were quite hard to quantify. So we focused mainly on the first part, and we made a model to estimate the impact. So now we'll tell you a bit about this model. And here you see a simplified balance sheet of a bank. And banks, of course, get deposits from their clients. And they use these deposits to make loans, and we call that financial intermediation. But banks cannot turn every deposit into a long-term loan because they also need to hold high-quality liquid assets, so kind of a form of cash. And how much they need to keep on their balance sheet is determined by liquidity coverage ratio, for example, and net stable funding ratio. And from this point on, it's still quite hard to identify the real impact. So we had to make a lot of assumptions. Well, the first important assumption that we made is that banks react to deposit outflows by reducing their high-quality liquid assets, so kind of their cash, as much as their liquidity ratio and their net stable funding ratio allows. And otherwise, they will attract long-term wholesale funding. What we did for this analysis is we aggregated the balance sheets of the 4 biggest Dutch banks, which represent more than 90% of the balance sheet total in the Netherlands of banks. And we modeled them as one model bank, like representing the Dutch banking sector. Also, an important assumption is that banks do not raise their interest rates to obtain additional deposits. Also, the model is static, so we used data of the 31st of December 2022, which means that this assesses the impact of what if the digital euro would have been introduced the 31st of December of 2022. Also, we assume that operational input is constant while deposits leave the bank, so that means that no people get fired because there are now less deposits at the bank. So the costs stay constant. And we have made quite some more assumptions, but we will not go into that due to the time. And how does that look? Now here you see the simplified balance sheet of the bank before the digital euro. So you can see the bank has sufficient cash. It's above the limit. So the dotted line is the liquidity coverage ratio. And you see that after the digital euro is implemented, the amount of cash is limited to the buffer and the gap is filled with wholesale funding. Well, this is then how that model looks for the input parameters. So what did we do? We fixed the input parameters for the bank and we fixed the input parameters for the market, but we started conducting scenario analysis on certain deposit outflows. And that led then to certain results, which we now go into. So we looked at four different scenarios. So the first scenario we looked at is what if people use the digital euro as a buffer? So kind of like putting cash in a sock. They put, for example, 500 euro on a digital euro account one time and they never look at it again. And for the rest, they use the waterfall functionalities to pay with the digital euro. Then we looked at what if people start using the digital euro as a means of payments. So what if people use the digital euro to do their variable expenses and fund their account per month. We assume that it's funded per month and then linearly defunded, and we base this scenario on CBS data, which is the Dutch statistics agency. Then we also looked at what if people use the holding limit to the full extent. And we assumed here a holding limit of 3,000 euro. And we also, in even worse case, we looked at what if people and businesses use the digital euro to the full extent. So before we go to the results, it's important to remember that we used a lot of assumptions. So these figures should be interpreted as an order of magnitude and not as real impact. Also, during this research, we made use of outside-in estimates. So there's no Rabobank data involved. Well, they allowed me to do my thesis there. There's no Rabobank data involved in these results. Furthermore, in the results, the adoption point of 49% is shown. And this point is based on the research done by Belsma, who researched how willing Dutch people were to open a digital euro account. And he found out that it would be around 49%. So then if we go to the results, here we can see the total deposit outflow based on my scenarios. So it's important to note that the deposits totals for 2022 were 1,336 billion. So for the first scenario, if you would have 100% adoption, so this was the scenario where only a buffer is used. And if everybody does that, 7 billion euros flows out of the Dutch banking system, which is equal to 2.5%, which is quite limited, I would say. Also, if you look at the worst case scenario, so scenario 4, so that is if businesses use the holding limit to the full extent, and if private individuals do that, and you have an adoption of 100%, you see 51 billion euros flow out of the Dutch banking sector. And this will be equal to a total of 3.5%. And then if we convert that to earnings, we can see that total earnings in 2022 were 9 billion. And for the first scenario, 136 million euro will flow out around percent in case everybody does it. And then in the worst case here, it's a bit more than 10% or 900 million euro if everybody adopts the digital euro and uses it to the full holding extent. Then we also looked at how does this impact the liquidity ratios. So you can see that the model bank, so the aggregated balance sheets of the Dutch bank started with a liquidity coverage ratio of 152%. And it would only drop 2% in the first scenario by 100% adoption and around a bit more than 14% in the worst case, still being a lot above the legal required minimum of 100%. We did the same analysis for the net stable funding ratio with a lower starting point, but you also see that the impact here is lower, so the decrease is lower. Well, also if we look at these results, it's also maybe important to think about how likely actually are these scenarios. Well, as the ECB pointed out, they want to develop the digital euro as a means of payment and not a store of value. And actually, the Dutch National Bank thought that the digital euro as a buffer would be the most realistic scenario, or even before that. So even less deposits put on the digital euro. Well, then if we look at using the digital euro as a means of payments, and then you're quite dependent on how will the waterfall functionalities work. So if they don't work very good, this might be more realistic. But it's also important to note that funding and defunding is quite inconvenient, and that if you get a salary of 3,000 euros, yeah, then or if it's higher, then it's already hard to receive your salary on the digital euro account. Also, if you look at the stress scenario, where everyone puts the whole holding limit on the digital euro account, it's also quite unrealistic, and only maybe in a really stressful scenario. And then even it's also very important to note that if you look at Dutch statistics, not every person even has 3,000 euros on their current account. Well, and for the last scenario, that would be the absolute worst case is if also businesses could hold digital euro. But at the point I was writing my thesis, it was quite unlikely that businesses were able to do that. Something else which is interesting is that for none of these scenarios, which we not necessarily expect beforehand, that there was no wholesale funding needed for any of these scenarios. So then we look now, when do we need additional wholesale funding to stay above this high quality liquid assets limit or cash limit? And we found out that every Dutch person above 15 could put 11,701 euro on their digital euro account before the liquidity ratio of the model bank was breached. On the earnings, it's very important to note that it's very dependent on the interest rate environment. If you look at 2021, where deposit facility rate at the European Central Bank was negative, it was actually beneficial for banks to lose deposits. Well, if you look at 2023, when the spreads widened, it was also more expensive to lose deposits, but the earnings rose as well. So if you look at the percentages, which I did, the percentages stayed almost the same. Well, and then we come to the conclusion. I hope I'm not over time. Well, the first conclusion is that financial disintermediation due to the introduction of the digital euro poses a manageable risk to the Dutch banking sector. And by that, I mean that is not life-threatening. It's important to note that the risk of financial intermediation is maybe already present due to stablecoins. So that's also another argument you could make here. The second conclusion point is that every Dutch person could put 11,701 euro on the digital euro account before the liquidity ratio of the model bank is breached. And it's of course very important to note that every bank has different liquidity ratios. But in my scenario, for none of the banks, additional wholesale funding was needed based on these scenarios. And I think that Dutch banks are quite similar. If you look at German banks, where there are a lot of smaller banks there, it might be a bit more tricky, for example. So the third conclusion, we just touched upon that the impact on earnings is highly dependent on the interest rate environment. And the last conclusion, I didn't go into that for this presentation, but in my thesis I also went in a bit on the impact on payment revenue, and it's not and development costs, and it's not necessarily given that financial disintermediation will be the biggest risk. It can also come from the impact of payment revenue, of course, depending on the remuneration per transaction or on the development cost. So that was my presentation.
Thank you, Willem. Very insightful, of course, and quite rigorous study there. Next up, we have Abdurrahman. He is going to take us through his thesis, which is entitled The Demand for Central Bank Digital Currencies in Decentralized Finance. Quite an interesting topic, in fact. Abdurrahman's research examines the growing relevance of tokenized CBDCs in the world of decentralized finance. He challenges the role of stablecoins, exploring whether a public-private model of tokenized CBDC could offer a safer, more legitimate monetary tool. Could you please help me in joining, or rather welcoming Abdurrahman to present his thesis?
Thank you very much for attending today. It really means a lot to me that you're here, because this is a topic I've put a lot of thought into. And so I have a question. And the question is, can we rebuild trust in the financial system? Because there is this growing inequality which always stayed in the back of my mind when I first started my university degree in economics. And during the first year, I had this course called Business Ethics, where we discussed the financial crisis. And I watched every financial movie, like Margin Call, Big Short, and I was angry that a small group of people could benefit of the rest of society during a time of crisis. So that was also around the time when I just found out about Bitcoin. And I thought, okay, this is the solution. But I could not have been more wrong. Around that time also, Ethereum had just launched, the ICO boom was in full swing. And when it all came crashing down, nobody believed, at least everybody believed, this technology is not going anywhere. But I stayed strong in my conviction, and I did continued doing research every day. And that's when the decentralized finance boom happened. Suddenly, I could use my magic internet money to gamble and play in this 24/7 online worldwide casino. And it reminded me a lot of my youth when I used to play a game called RuneScape. It's a game where it's a massive multiplayer game where a lot of people are thrown into this world, and we all did all kinds of economic activity. And when the time came to write my graduate thesis, I knew I had to write it about crypto. But I thought, because I was so deeply involved in the industry, I thought I already know everything, but I didn't know this thing called central bank digital currencies. And I thought, aren't stablecoins and CBDCs the same thing? So that's what I head out to explore. And later, after my graduating, I started working at the Dutch Payments Association as a digital euro policy advisor, where I worked with the Dutch banks and the Dutch Central Bank on the implementation of the digital euro in the Netherlands. And and when I was writing my graduate thesis, of course it was, I did finance, so it had to be empirical research. And in this, the first variable that I collected data on is called the crypto GDP. And you might think crypto is all speculation, but from I found there is actually productive activity happening within this economy. And due to limited time and resources, I have only collected data for 3 sources of income within this economy. And the first source of income is within this new digital economy is Bitcoin and Ethereum mining profits. Here you can see the price of Bitcoin and the amount of Bitcoins being mined every day. If you just multiply it, you have the total amount of revenue earned by all miners within this economy. And you can do the same for Ethereum mining. And the second source of income within this economy is called wages earned by blockchain developers. And I just multiplied it by the mean average wage of a software engineer and the amount of blockchain developers. And the third source of income within this crypto economy is yields earned by decentralized finance applications. And here you can see right now there's approximately $100 billion worth of assets in these financial applications. And to be sure, is everybody here familiar with what decentralized finance is? Please raise your hands. I see some hands. So nobody else knows what decentralized finance is? You do? Okay. Could you please explain it?
For instance,
Yeah.
there isn't intermediary. There's business, BTs. There isn't a counterparty risk. There is smart contracts.
I'll give my explanation as well. Decentralized finance application is application built on top of Ethereum or on Solana. And users all around the world can send their Bitcoin or Ethereum or stablecoins to this application, and other users can trade against it like an exchange or borrow or lend from it. And they pay a fee for this, and this fee is paid out as profits to these applications. So now that we have established that there are three sources of income within this crypto economy, so mining profits, wages earned by developers, and yields earned by decentralized finance applications, I have found that this creates a demand for money. And when Facebook said, we are going to satisfy this demand by releasing a stablecoin, regulators all around the world immediately rushed to shut this project down, and shortly after, which they did successfully, and shortly after introduced their central bank digital currency projects. And important to keep in mind with stablecoins is that they, the key difference is they have 24/7 instant settlement, have no borders, and is accessible for everyone with an internet connection. One minor setback is that the Bank of International Settlements does not recognize stablecoins as a form of money because of frequent peg failures and redemption uncertainty, which undermines their reliability as a store of value. But this has not stopped stablecoins from having explosive growth. Right now, there are $200 billion worth of stablecoins outstanding. And right now, there are $200 billion worth of stablecoins outstanding. And this means there's no new money being created. It is simply deposits flowing from fractional reserve banks into full reserve banks, where the liquidity is locked and can't be accessed for making new loans. And does that sound familiar? It's exactly what the digital euro legislators fear with regard to the holding limits. Here, what you're seeing with the growth of stablecoins is money flowing out of banks, and the liquidity is locked. And that's exactly what we fear with the digital euro. So you might think, where does this theory come from? And it is based on classic economic theory like from Irving Fisher and John Maynard Keynes, called the quantity theory of money, which states that if there's economic activity, there will be a demand for money to facilitate transactions and support economic activity within this economy. John Maynard Keynes later came up with the money demand function, which states that as the real GDP of an economy rises, or the income, the demand for money will also increase to support this increasing economic activity. And that's exactly what my empirical research is based on. I have taken a daily time series of this crypto GDP data I have collected from 2014 until 2022. And I have regressed it against the growth of stable coins and did a co-integration test and can confirm there's indeed a relationship between these two variables. And the results show that as the crypto GDP increases by 1%, the demand for money within this economy increases by twice as much. This means that as the crypto economy continues to grow, the demand for money will also grow, leading money to flow out of fractional reserve banks and to full reserve banks. And this problem is unaddressed by the digital euro, simply because it does not satisfy the demand for money being created by the crypto economy. Why? Because the digital euro does have borders and is not accessible for everyone with an internet, it's not accessible for everyone. For example, someone in Asia can open a wallet, receive their stablecoin, and just send it to their friend in South America. You could just say, open a wallet and send me your address, and they could just send it without any hurdles. Now that we have had all of this, I would like to make a couple of predictions. And the first one is, now that the United States has put their weight behind stablecoins, I think in a very short period of time, stablecoins will grow to at least $1 trillion worth of stablecoins outstanding. Which leads to my second prediction, is that regulators will finally recognize as a serious financial stability risk and consider evolving stablecoins into some form of synthetic CBDC or wholesale CBDC. And a synthetic CBDC is basically the stablecoin technology wrapped around central bank reserves. And my third prediction is, I believe perhaps that the digital euro legislation could serve as the backbone for using synthetic CBDCs as a payment method or legal tender in Europe and in the crypto economy. Now that we had all of this, I put you to think, and I would like to brainstorm together. I have a couple of questions for you. And the first one is, would there be demand for the digital euro if it is not compatible with crypto? Please raise your hands. Yeah. For the digital euro. Why?
Cases for people that aren't in the crypto space still exist. And I guess digital euro can have some value which bank deposits cannot at this stage.
What kind of value?
Cross-border transactions in the European Union itself, for example, we have banning on the outside, instant payments, and more secure.
Mm.
And one more, when you break statement about DeFi, when you place your funds for building.
So for?
Building. I need to earn the yield.
Yeah.
It's very short term.
Mm-hmm.
And many guys from DeFi sector that are coming to our traditional sector for the yield. And it's very popular now for platforms which are giving DeFi sector an opportunity for the yield coming from traditional financial sectors.
Yeah.
You know, US treasuries, we know scientific this So I think that the most profitable approach is to use the opportunities from the broad DeFi and
yeah.
build the digital.
Exactly.
And too many guys from DeFi, I'm doing both.
Mm.
I have more than 37 years. I'm doing both. I think you shouldn't be, let's say, negative to the rest of the. I mean, DeFi again, DeFi traditional finance. We must work together.
Yeah, I agree.
Yeah, this is the point. Actually, the touching point is really what matters.
Yeah.
This is a touching. And
yeah, it's still very much figuring out how these two worlds are going to come together, and in the real world and regulations, and if they even can really work together. It's still a space to explore, and that's exactly what I want to achieve with my thesis, like finding where the nuances are and how we can.
I mean, agnostic approach is the most. Agnostic means that if there are not evidences to use this particular financial instrument, go there. Don't say about it.
No. So the second question, at least, did anybody else have something to add? Mm-hmm. Yeah. And which use cases are you thinking of? Mm-hmm. Mhm. Yeah, because for example, at the Dutch Payments Association, we are subsidized by the banks, so ING, ABN, and Rabo. And we always argued, at least at the Dutch Payments Association, we said, why do we need a digital euro? We don't need it. We have EPI. And why would people even go to the digital euro if we have Visa and MasterCard while it already works? We were already wondering, can we even get EPI going? So I always thought from a perspective that the digital euro has to offer something new. And yeah, so also the, for example, the monetary sovereignty and the fragmentation of the payments market, yeah, those can be solved with EPI, for example. Anyway, yeah.
What the most stable holding reserves?
With regards to, yeah. So Luna, I'm not a proponent of Luna. Yeah, of algorithmic stablecoins. So the ones I am a proponent of is, well, at least I am not really a proponent of full reserve banking even. I am more a proponent of accessible for everyone and no borders. Yeah, I know you have this risk with regard to illicit financing, but this risk also exists with with regular dollars, and this freedom of being able to send money is what has allowed real innovation to happen. Real innovation to happen.
So this is not a stable coin. It's a freedom coin. It's stable. You should hold reserve, which is absolutely there. Otherwise, how are you going to protect the customer?
Yeah, so with regard to so fiat stablecoins in the case of Tether or Circle,
USDC.
that yeah, USDC. So Tether doesn't well, at least nobody really believes their audits. Well, they have proved that they can redeem. They can do redemptions. They have proved it by redeeming at least, I think, 10 or 15 billion during the Luna crash. So they have proved themselves, which I think is actually the most important factor because Circle does have audits. We believe it, but they defect. So, and Luna, I'm not a proponent of it at all. Like, I don't believe in algorithmic stablecoins. I just want to see a free money because Bitcoin is, before 2017, everybody said, yeah, Bitcoin, that's going to be the money of the future. But Bitcoin is not a store. Well, yeah, it's not money. Money is unit of account, which you can exchange with, and a store of value. Stable coins do look the most familiar to money, but it's not actually money, according to the Bank of International Settlements. But anyway, let's go on to the second question, which is, can a digital euro exist that functions exactly the same as stablecoins? So accessible for everyone and no borders. Do you believe that can exist?
Yes.
Why?
I do. Especially for retail. It's possible. And it will happen.
Mhm.
Because you could open your digital wallet everywhere without any permission.
Exactly.
That's why.
So, but can a digital euro backed by the ECB, can that also exist? Like with free and accessible for everyone and able to use in crypto as well, like in decentralized finance applications. Can that exist?
It's going to be a different protocol. So again, we're looking for a bridge between digital euro, but we're fine. I don't think.
Does does somebody else also have an opinion on this? Yeah. Well, it does pose risk to financial stability. Yeah. Yeah, the dollar already has it, but we do want to protect our own. We want to protect Europe. So anyway, anybody else on this question? Yeah, exactly. I completely agree. Because if there's a decentralized finance application which is built by some genius coder somewhere around the world, and I want to send my money there, like 10,000 euros, I won't be able to do it, which doesn't make sense.
Can you imagine what's going to happen with the balance sheet of commercial banks? Can you imagine how volatile it's going to be the one?
Willem actually showed it. Yeah, he was showing what was the you were showing like 40 billion or 50 billion like stable coins. Right now there are 200 billion dollars of stable coins outstanding. That means directly $1 for every stable coin that's outstanding is being backed, allegedly. Yeah, and it's going to $1 trillion, I predict, now that the United States is backing.
Commercial banks, which is Europe, they don't support each other in general.
Yeah, we were against it.
Their biggest support. Real
Yeah.
Like coal industry in Germany also needs a transition plan to stop coal. Same you need for the banking industry because they are represented against it.
Yeah.
Comes you need a transition plan, but 3,000 limits it makes no sense. You can forget it.
Well,
You
we
need the transition plan.
and the digital euro legislation actually does force banks to think about this. What I have noticed, because we as banks we were completely against it, but the European Commission pushes through with the legislation, so we were forced to have a positive look at the digital euro. So I think that's a good thing about the digital euro legislation. Yeah.
But I think that with the volume limits, it will come down to what will be remuneration per transaction for the commercial banks. Because if the payment side of the digital euro will be more efficient than the current payment factories of banks, there will also be a strong initiative, incentive for banks to allow this. And then even it can be useful with volume limits. It should be if the remuneration per transaction will be the whole system will be more efficient, then there will be also incentive for banks to pay this side.
Yeah. Yeah, I believe with the commercial bank money token, it's you have this KYC boundary, and you can't go outside of it. And what I think will happen is you have this unregulated industry, which decentralized finance, that will continue to grow, but you will also have banks adopting blockchain technology and using this commercial bank money token, which they will probably use to facilitate with wholesale CBDCs and settle securities, tokenized securities transactions. So you'll have this regulated blockchain industry and unregulated industry. But I believe the real innovation is happening outside in the unregulated area. And that's actually where you should be focusing. And yeah, I still think it's good that banks think about how can we apply this technology in a compliant way. Yeah.
Zero knowledge protocol.
Yeah. Okay, and for my last question is, could synthetic CBDCs be considered as legal tender under the digital euro legislation? So could it be used as payments as legal tender in the point of sale and also in the crypto industry? Mm. Mhm. Yeah. Yeah, because ideally, I would love to be able to use this cash for both DeFi, but also to pay at the supermarket, and it just all I see is just €1, not Circle euro or Tether euro. I don't care. I just want a euro which I can use everywhere. Does anybody else have an opinion on this? So it's very simply said, it's a stable coin wrapped around central bank reserves. So it's risk-free money, risk-free stable coins. Right now, stable coins are pegged to a euro because I give you a coin, I say it's €1, and everybody here believes it's €1 because you trust that if you give that euro to me, I'll give it back to you. But with the synthetic CBDC, it would be backed by central bank reserves, which is actual money. So it's guaranteed to be risk-free. So to answer my first question is, can we rebuild trust in the financial system? I am not so sure because the boom and bust cycles which lead to inequality continue to persist within the crypto economy. But I do believe that this technology can create more inclusiveness, more transparency, and lead to a fairer society for everyone. I hope I left you with more questions than answers. Thank you very much for your attention. And yeah, thank you.
Great, thank you, Abdurrahman. Very engaging discussion. And our third presenter now is Michael Dours. He delves into the legal backbone of the digital euro. His thesis is entitled Evaluating or Analyzing 3 Key Legal Issues of the Single Currency Package. Of course, a very important aspect of the digital euro coming to fruition. He delves into the legal backbone of the digital euro, like I said, focusing on legal tender status and the right to cash and data privacy. And he also evaluates the legislative proposal from the European Commission and the ECB through the lens of constitutional law, policy goals, and democratic accountability. So let's all give Michael a warm welcome to the stage.
All right, thank you for inviting me today. So we're going to delve firstly into the methodology. I let myself be inspired by Lord of the Rings for the subtitles. So the Fellowship of the Digital Euro, where everybody fights over competence. The two towers of the right to cash with two really important parts, acceptance and access. And of course, always the return of the privacy king since GDPR. So for my methodology, I analyzed the general policy goals of the ECB and the Commission and the specific policy goals for the digital euro and the single currency package. And these were the five we determined. So complement cash, not replace it, ensure financial stability, which Willem already discussed. Existing legal frameworks must be respected, the importance of privacy, and of course the universal availability, financial inclusion, as Abdurrahman had an interesting discussion about. And I held it against three legal issues we identified through doctrine. So the competence to adopt legal tender, the codification of the right to cash, and CBDCs versus privacy. So in the Fellowship of the Digital Euro, we look at Article 128, which I mentioned before, and Article 133, which gives the Commission competence to adopt bills or regulation about the currency as a whole, and Article 128, which gives the ECB the competence to publish legal tender and to issue legal tender. But of course, CBDC is a novel legal tender, and it's the first adoption of legal tender we had since the introduction of the Maastricht Treaty. And of course, there could be a teleological interpretation of the TFEU that banknotes could be associated as that CBDC is just an extension of banknotes. But of course, it feels very difficult to defend it. And then also the digital euro is being used as an economic and monetary policy instrument. It's mentioned in the proposal, and the ECB doesn't have competence on that point, rather the Commission has. And then we have the discussion about banknotes versus currency. Banknotes are mentioned in Article 128, but Article 133 mentions currency, and it's actually stronger to align CBDC with currency rather than with the notion of banknotes, of course. Could there be a treaty amendment? In theory, yes. In practice, probably not. I think it's very difficult for such a small change to have the necessary backing by each European country, especially as there will be a lot of rent seeking and a lot of other actors trying to push through other amendments in not so relevant aspects for digital euro. And of course, the fragile balance of competence they have created for themselves. They have the legislative competence lies with the Commission and in extension the Parliament and the Council. However, architectural decisions and the holding limits, which is a very important part, as we have discussed already today, are located with ECB. However, the holding limit is a very contentious aspect because it's also a kind of an economic and a monetary policy decision. And it's very unclear, and it's not actually regulated or controlled by the Parliament, which is the most important democratic actor in the current state of the EU. The architectural decisions are also important, and currently these two processes of legislation and architecture run parallel, but as we will see, with regards to privacy, it's very difficult to regulate something when you don't even have an idea about the architecture. Moving on to the right to cash, for me personally, a highlight of the single currency package. We have the two towers, as I discussed, acceptance and access. Acceptance is something that was already kind of recognized within the EU through legislation and also through the European Court of Justice. So it was more of a codification effort and codifying in a regulation the current acceptance regime within the EU, which differs per country still. However, the countries still retain certain broad powers with regards to the acceptance and both the access. However, the access, as the Commission identified, is necessary for the acceptance. If you don't have anywhere to get your cash, it will be very difficult to then use it in any shop you want. Then finally, the return of the privacy king. Of course, since the GDPR, a very big topic, I think every company regularly has problems with GDPR or compliance issues with GDPR. It's a very broad regulation, and it also has an impact here, of course. However, they try to address it in Chapter 8 of the Digital Euro proposal. So they recognize the principle of privacy, and that has to be recognized in infrastructural decisions. And they try to address it through the online and offline digital euro. However, as through doctrine, it became clear that it was actually a missed opportunity, as the EDPB, the European Data Protection Board, recognized that CBDC may offer opportunities with regards to privacy, but that these were not recognized by the current proposal. So we have the role of payment service providers and the role of the euro system. We will have to monitor the holding limits, and we will have very broad access to basically look at everyone's accounts. I oversimplify a little bit, but that's what this comes down to in practice. However, as we mentioned, there is still a lot of technological uncertainty, and some of these issues may be addressed through the architecture of the digital euro. Then we have the role of providers of support services, which is still very unclear, and also it seems like they forgot to write dispute resolution into Annex 5 with regards to the data access they will have, but we'll see in future proposal how they will address it. Then a few selected issues, the AML CFT framework. So I think for the online digital euro, it stays kind of the same. The offline digital euro, they say they will not look at transaction data, or they will look at transaction data, but then at that point, I don't really know what the difference would be with the current AML and CFT framework. Then there is a labyrinth of competences. The ECB will have to monitor their own privacy with a little bit of support from the European Data Protection Supervisor, as will the Commission. In my personal opinion, I don't think the Commission has a very good track record with regard to privacy, so maybe an overarching supervision mechanism could be interesting here. And then, of course, the principle of data minimization versus innovation. In the digital euro, they aim to address disintermediation through holding limits and through the extra services they may create. However, auxiliary services, they will have a very negative effect on data minimization, and I think it will be difficult to reconcile it with the general GDPR regime, as you will look at probably for a lot of people, very sensitive data, their payment accounts. And I think it misses the point with regards to privacy. To conclude, to look back at the single currency package, I think it's a mixed bag. I think it's very strong with regards to the right to cash. I think it's very important that the use case of cash is well defined. However, I don't think the use case of the digital euro is as defined right now between digital bank money or commercial bank money and cash itself, as cash itself offers a lot of privacy options, which this digital euro currently misses the mark on. Then with regards to financial stability, I think there are very broad protection mechanisms. In my opinion, a little bit too broad. I am not as well educated with the financial aspects as Willem and Abdurrahman, but in my opinion, the question shouldn't be, can everybody transfer their money to the digital euro? Will they transfer it? I think the option of that was established in Article 16, that there can be no interest or no yield as in stable coins on the digital euro. I think that's the protection mechanism for banks. I think they should ensure that they have the necessary deposits through adopting interesting interest payments with regards to savings accounts. I think the digital euro is more of a checking account rather than a saving account for most people. So I think it will only be a proportion of deposits that will be lost. Even in that case, I don't think holding limits are necessary for the digital euro. And if they are necessary, maybe in a tiered system, as one of the audience members mentioned, that it should be a process and not a one-day change. Then the existing legal frameworks. As I mentioned, I don't think it's in line with the current treaty, but I don't think it will be necessarily addressed. And it was a codification effort with regards to the right to cash. Then finally, privacy is essential. However, currently it misses the mark. And architectural choices will be essential. And I think that's also the point I'm making with regards to universal availability, financial inclusion, and ease of use. The architecture will be more important. We have a lot of opportunities there, and I think the ECB should take these opportunities and seize them completely. So thank you for listening, and also congratulations to the other two Thesis Awards laureates.
Thank you, Michael. That was quite engaging and also quite informative. Of course, the legal package, quite an essential part of delivering a successful digital euro. And now perhaps the time we've all been waiting for to announce the order of the finalists. Each finalist will receive a certificate, but also a cash prize, as stated in the Thesis Awards communication. And in third place, and from the University of KU Leuven, we have Michael Dours. Thank you. Congratulations, Michael.
Thank you.
All right. And now, in second place, from the University of Utrecht, we have Abdurrahman. There you go. And of course, then, in first place, from the University of Twente, we have Willem Vincent. Congratulations.
Thanks a lot.
No problem. Congratulations. Great. So to all of our finalists, thank you very much for your inspiring work. Your work is well recognized and doesn't go unnoticed. And we are certain that it will make inroads towards, the future of digital money. So congratulations to you all again. We have a few minutes before lunch, but that's your free time to go and explore the rest of the program. But otherwise, just one more round of applause for our finalists.